for staying with us. We are I'm now delighted to bring on board Jim O'Neill, former chairman at the Chatham House and the former chief economic advisor with Goldman Sachs, former commercial secretary at the UK Treasury, and the man, which is more important, who really came up with the acronym BRIC. So Jim, we are talking to you at a time when nobody knows what is coming. All we know that American markets, they have reversed. Fears of a genuine slowdown in United States is a reality now, and investors are moving out of the long dollar trade. What, to your mind, is the big headline on 21st of March 2025 for financial markets?
I think, as I've discussed with you in December, you've got to be very careful of a very strong consensus when some of the underlying factors aren't so clear cut. And I was quite skeptical in the immediate euphoria of Trump being elected that this was going to further accentuate so-called American exceptionalism. And I think the reality is what we've seen over the first, 60 to 70 days, the US isn't exceptional. It has many, many outstanding things, but the markets were priced for exceptionalism. And it's quite clear that some of Trump's initiatives, especially tariffs, are causing considerable angst to both US consumers and US business, as evidenced in both consumer and business surveys. And most concerningly, as I think I also discussed with you, if you look at the University of Michigan's 5-year inflation expectation survey, which has been around for decades, it's risen to 3.8% in its latest reading, which is over a 30-year high. And that will not make life at all helpful for the Federal Reserve in trying to pursue the appropriate monetary policy for this very, very complicated background that Trump is creating.
So Jim, if I just throw more ingredients in the melting pot, one ingredient is that what happens to the US debt. The current administration is committed to bring the debt down. If the debt comes down, that means it could have an impact on the government's ability to spend. Now, US has managed to print their way to prosperity. If that reverses, what will that do to US economy, US earnings, and to the rest of the world?
So I guess if there's one saving grace as a result of all these developments, is US bond yields have actually come back down again, almost reversing a lot of the post-November euphoria rise in yields that went along with the stock market gains. And 10-year yields and other parts of the yield curve have reversed quite a lot of that. And it's quite interesting that if you look at what Trump is now occasionally saying, it seems like instead of him watching the stock market so much, he's watching the bond market. And here I do think his Treasury Secretary, Scott Bessent, is probably playing a role. And I think they're sort of hoping that that will continue. And with it, the Federal Reserve Board will pay attention and start to get friendlier again. And the Fed will end up cutting interest rates more. That could be a saving grace, because otherwise, as you imply with your question, the rise in US debt and what seems set to be further fiscal stimulus from the Trump administration could create a whole new set of problems for the United States. And of course, as is discussed on and off over seemingly decades, the interplay between the appetite for US debt and the role of the dollar in the global financial system actually could become a fragile issue if Trump carries on at the same time with this almost confrontational style that on some days he and his colleagues seem to almost enjoy in pulling apart the whole of the post-Second World War global structure of governance that, of course, the US effectively put together and has led. But if the US is going to genuinely pull that apart, I'm not sure that it will be quite so easy for them to attract as much foreign buying of US assets, particularly fixed income, as they have. So it's not surprising that the markets are not entirely happy about all of this, because if you did have a problem with the US debt market, that would compound the fears now starting to escalate in US equity markets and cause people to dramatically reverse this idea that there is something exceptional about the United States.
Would be the pain threshold for financial markets, and what point beyond which it would say that the fall in the US market has started hurting them? I mean, 2008, it was a specific problem with banks in United States, but it really haunted everybody. What could be the threshold level?
That's a very good question. Of course, we all always look at history to see where the issues became so clear and expect them to appear there again in the next financial uncertainty era. But quite often, of course, they come in places you don't expect. So I think it's very difficult to have confidence about that. But I guess the one that would be particularly challenging these days would be related to high yield spreads and more broadly corporate bond spreads. Given how sophisticated corporations have been, including the whole private equity world, in using leverage to both buy shares and to expand their businesses and to buy others out. If we started to have a problem in the high yield bond market and in corporate spreads in general, that would escalate all sorts of connected issues and probably play into considerable challenges for the banks as well. Luckily, at least at the moment, there are no real signs of anything like that, but that would be amongst the things that I would be wanting to watch quite carefully.
Now, Jim, what are markets betting on? Are they betting a slowdown in US economy, or as the year unwinds, their fear of recession could hit US markets?
So, what is, when I hear that you ask that question, what is very interesting for me, and again, it touches on what we chatted about in December. At the same time as all of this, or possibly because of some of this, there has been a very significant outperformance of non-US equity markets relative to the US, particularly in Europe, led by Germany, and also to some degree, of course, with China. And what remains really interesting for me as we go through the next 3 weeks and into the Western summertime is whether this is signifying that the markets actually now believe that growth leadership for the world is shifting away from the United States and to a more resurgent Germany and therefore Europe and to some degree China and the emerging world. And I think that is not, it's early days to have too much confidence about that, not least because it's never happened for a long time. But there are grounds for believing that that could be the case because, of course, if you take Germany, for example, the complicated politics and the rise of the far-right AfD ahead of the recent election, together with their own recession and the extreme pressure from Washington on defense spending and tariff threats to Germany, huge exporter, has led to this pretty dramatic change in German policy framework, which is something people like me have been suggesting Germany would need to do for well over a decade. And it looks to me like the Germans are pretty serious. And if that indeed turns out to be the case, this could give a much more solid footing to a more sustained, let's call it Europe-wide domestic-driven period of expansion. And of course, given that the population of the EU is effectively the same, if not bigger than the United States, and the economy not too far behind, this could be a very important counterweight for the world economy at a time where the US looks like it's going to go through some struggles. And then, of course, some version of the same might be beginning to unfold in China, although I have to say, I think the policy signs are still a lot more tentative and hazy. But if you had those two things going together, that would mean for many other parts of the world, the issues of the United States could be mitigated a bit more. And in a sort of bizarre way, if I connect it all together, not that I think consciously this is what Trump is trying to pursue, but indirectly, an economist could have said that would be the consequence of Trump pursuing the policy direction that he seems to be going down.
Jim, so you have to rate the markets in terms of potential returns, let's say from March 2025 to March 2026. Doesn't matter what the market is, doesn't matter what the tariff is. Where do you think this market, which three markets do you think have potential to give double-digit returns from here, absolute double-digit returns?
Well, I'm gonna sort of cheat my way out, and again, making reference to a lot of things I was saying at the turn of the year, including in conversation with you. What was so interesting against the background of this euphoria about Trump coming in was this pretty widespread belief amongst what I could see the sell side consensus that the US would continue economically and in terms of its equity markets and the dollar to outperform the rest of the world, certainly through 2025 and to some degree beyond. But what was clear to me, and this is what I really want to answer you by saying, is I think over the remainder of this decade, it is quite likely that US equity markets are going to underperform much of the rest of the world, or a more positive way to put it is I think the rest of the world, which was very cheap, particularly Europe and to some degree China, is probably going to outperform the US. And it, of course, that has already been the case in the short 3 months of nearly, or 2.5 months of 2025 so far. And I wouldn't be surprised if that continues erratically for much of this year. And whilst the tariff, the period between now and April the 2nd, will probably see some near-term recovery of the dollar as people become convinced that Trump is going to impose a lot of tariffs. I do not think that the combination of what the US is trying to do is at all good for the sustainability of the dollar. And I would imagine this time next year, the dollar is going to be probably quite a bit weaker against lots of major currencies around the world.
Jim, do you also see any concerns in terms of the debt ratios? I mean, Europe also has a lot of debt. It's not that they've got a very, feather-light balance sheet. Japan also interest rates are moving higher, which could have impact on yen carry trade. Do you worry about this unknown factors which could be at play as the money reverses from US?
I think one always has to worry about rising bond yields. I've been around for so long that I've lived through some of the very few nasty multi-month periods of bond market sell-offs. I remember 93, 94 in particular, which was vicious. And the consequences of that were much more challenging for many things than people expected. And of course, as it relates to Europe, we had the extremely challenging situation of the euro crisis, and we've had a bit of a forerunner of it with the sell-off in US bonds late last year. But all of this, or for the past 20 years or so, has come against the background of almost negative Japanese interest rates and close to zero Japanese bond yields. And as your question implies, in the background of all of this is a slow creep higher going on in Japanese bond yields. And I'm not quite sure where they are today, but they're in the vicinity of 1.5%, which is already a pretty big move from a year ago. And given what's going on internally with the Japanese economy and Japanese inflation, the Bank of Japan is probably going to raise interest rates further. And if the rise in Japanese bond yields did start to get out of control, as many famous investors have expected on and off for the past 30 years, that could cause huge dilemmas for financial markets, given the connectivity of them all, including, of course, at the middle of it, the so-called Japanese carry trade. I think because it's been feared and worried about for so long, including from the Japanese authorities, I think the BOJ is going to be really careful about how it progresses to higher rates, but it's not impossible that it could get out of control. And that would, the consequences of that would be, I think, reasonably clear, that you would see a dramatic recovery of the Japanese yen, and any overseas markets that have been particularly beneficiary of Japanese retail investment would go through quite a lot of challenging problems. I wouldn't have that as in my sort of main likelihood of things that are going to unfold, but it's certainly out there as a major thing to keep an eye on. Well,
Jim O'Neill, really appreciate your time. So glad you could join us with your valuable inputs. Always a pleasure talking to you, sir.
All right, have a good day.
Thank you very much. Jim O'Neill from London. And why was he sweating? It's very cold in London. Maybe just one of those camera things. Let's take a break. When we come back, last 1 hour 30 minutes of trade left. 450 points up for the Sensex, 100 points up for the Nifty. Breath looking good. So it's turning out to be a terrific Friday for Indian markets.